Hello, welcome back to a new video, and today I want to talk about divergences. I know I made another or previous video like 2 years ago, but I think it's time to make an update. Nothing has changed about divergences. They are always the same. They will always be the same, but I think I have a different way of explaining it, a few different things that I want to share. So I think it's a good idea to just make an update and have you get an understanding for divergences. And we are going to use the RSI now. It does not really matter which indicator you use. You can use a stochastic or a MACD as well. It works exactly the same. All the principles are the same, but I just like to use the RSI, and that's why we will stick to it. By the way, I just got a new book here from Jordan Peterson, 12 Rules for Life. I'm really excited to read and get into this, and I thought about making a little review video, maybe pick a few chapters or a few things about this one and share it here on the channel as well. So if you're interested in something like this, a little bit away from the regular trading stuff, a little bit more into becoming a better version of yourself and emotional and psychological aspects, let me know in the comments below. It would be great to hear from you if you are interested in something like that as well, and that would be really cool. So let's get into this here, and I picked one random chart. It's a 4-hour time frame, which I'm always using, but essentially you can use any time frame, any market, whether you use Forex, futures, stocks, even cryptos probably. You can use RSI divergences or any divergences. They work on all time frames, so that we have this out of the way. Let's first revisit the RSI and understand what the RSI does, and then we can understand what an RSI divergence is much more easily. So we picked here the RSI. The default setting is quite okay. There's no need why we should change the default setting. So let's stick with the 14, and 14 means that the RSI is analyzing 14 periods of price action, or in this case just 14 candles. So what is the RSI? The RSI is a momentum indicator. It analyzes trend strength. And so when the RSI is here at an absolute high, it means that the previous 14 candles were very bullish. So the RSI essentially looks at how strong are the candles. Are they bullish? Are they bearish? Are they closing near the top or the bottom? And how is the ratio between bullish and bearish candles? So in this case, you can see over the past 14 candles, there were mostly bullish candles, just one little red candle here if we zoom in closer. So obviously the RSI will be very, very high because there are no bearish candles. If we move a little bit forward, you can see the RSI is moving down because over the past 40 candles, now you can see, although there were more bullish than bearish candles, so the RSI is still here trading at 64, much more bullish than bearish candles. There were a few more bearish candles now recently, and that's why you see here the RSI is dipping. If we look here maybe at a low RSI reading over here, let me move that so then we can understand what is happening here. And then we look back 14 periods. You can see now that over those 14 periods, the RSI is here at 40. So there are more bearish than bullish candles overall, and that's why the RSI is moving lower. The RSI essentially just analyzes how many bullish candles are there, how many bearish candles are there, what is the size. So you will see if the RSI goes up, it means there are more bullish than bearish candles. If the RSI is down, it means there are more bearish than bullish candles over the past 14 candles. And that is essentially what the RSI does. The RSI is a trend indicator, so you should only use the RSI during a trending market. Here, when we look at the RSI here, the RSI is pretty much here in the middle at the 50 level, 40 to 60, which means that there's roughly the same amount of bullish and bearish candles. And we can see that here as well. There is no momentum. Price is just moving in a small range up and down without any trend movement. So again, the RSI is in the middle. It's not very helpful. And you should make sure that you stick to the RSI only when the market is trending, showing us nice trending moves in one direction. And that is when we will use the RSI. So as I said, the RSI can be used for trend analysis, and here obviously we have a very strong trend, and let's see what the RSI tells us. First of all, we can see here the RSI is going up, and here we are in this trend wave. So the RSI is showing us the trend is very strong. Then we have a second trend move here, which then here is showing us here in this area that the trend is going up as well. Here, this is where the RSI tops roughly. So this is in this area, and it means that the RSI shows us here we have a strong bullish move, here we have a strong bullish move. In both cases, the RSI is here at the same level, which is around 84. So if we draw in here a horizontal or a trend line, it means that here the RSI is at the exact same level. In both cases, the RSI shows us the trend is very, very strong. So you can see it clearly here. In this period, we have much more bullish than bearish candles. In this period, we have much more bullish than bearish candles. And the RSI is showing that the ratio here is roughly the same. So that is already a good start. We can see the RSI is helping us to understand trend strength. But then something happens here. We see that the RSI is going down, and here we see that price is making a higher high. So you can see the price is making a final push, but obviously something is here very, very different. Over this period here at the top, we can see that the bullish candles are not really that strong. We see a lot of sideways movements. We have more bearish candles as well, and the final push is much weaker than when we look at this period or when we look at this period. The RSI confirms that here, although the RSI is still trading here at a 75 and the RSI is going up from here to here, the RSI shows that the top here or the high is much lower. We would call this a divergence because the price action on our charts and the indicator is doing different things, so they are diverging, and that is essentially what a divergence is. It is when indicator and the price action is doing something completely different. And what does this mean? It tells us that although when we just look at pure price action, you can say, yes, the trend definition is intact. A trend is a trend when the price is making higher highs and higher lows. We are seeing this here in this case, but actually when we look a little bit deeper into the price action, when we look at the exact candle distribution, we look at the bullish and the bearish candles, we compare them, we look at the strength, then we can see actually, yes, there is a trend, it is going higher, but the trend is losing strength, it is losing momentum. So it can be a very good first warning signal or just a heads up that something here in the trend structure is changing and it requires your further attention. We can see then here afterwards the trend is actually over and we are moving lower. So divergence is a good way of understanding when a market is losing strength. The RSI works both in uptrends and in downtrends. You can use it for both directions, rallies and sell-offs. And here's also an interesting market. So here we are clearly in a downtrend, prices making lower lows and lower highs. The indicator is agreeing here. It is showing us that the price action is actually very weak. The RSI is trading here at the very, very lows. So that is a good sign. Here at the bottom, price or the RSI is making an equal high. So this is important. It is not a divergence if the RSI is showing equal highs. It just means that the price action is weak. It is weak in both instances, whether we look at this high here or at this high here, or low actually in this case. It just means that the price action is very weak. It is having the same strength. So this is not a divergence, very, very important to understand. Then here we can see we are moving here into a new low, and here something is very different than here. You can see the price action is again showing us a lower low, but here at this point we are seeing that the RSI is actually showing us a higher low. If I draw this correctly in here, here is then the higher low at the RSI. And why don't we look at this here in between? We can look at it too, but usually you want to see that the price action and the swing lows on the RSI a little bit closer together, because obviously we chose the 14 periods here on this RSI. So the RSI only analyzes 14 periods. Here in this case, it is a little bit longer. So if we look here at this swing period, yes, we would get a RSI divergence, of course, as well, but usually we want to see that the swings are a little bit closer together, and that's just why we would not look at this specifically. We can look at it, and obviously we can get the same information that this first trending period here is obviously much weaker, stronger to the downside, depending on how you look at it, than this period. Although you go down here, you have a much bigger retracement, so clearly this period here is a little bit weaker. We can still use that as indication that maybe something in the trend is changing. And then here we have the final divergence. Also, this is a good example. Yes, divergences are very, very good. They can be very helpful, but at the same time, divergences should not be used to be traded on themselves. A divergence alone is not a strong enough signal. You need to have other building blocks for your trading strategy, how you time your entries, so the divergence can be one part of your trading system, but you need to have other things around it to build a robust trading system to avoid a lot of the failing signals, because there will be always a lot of false signals. If you just use a divergence alone, if you combine it with other tools, then you can build a very robust signal or very robust system. You can see here then this divergence shows the price action was much weaker. And actually, what does this divergence show us? It basically compares this trend wave with this trend wave. 14 candles here roughly in each, and you can clearly see obviously here we don't have the strength to push as low. Here in a short period we have a much stronger move to the downside compared to here. Here obviously we then have a much weaker trending phase. We just barely make a lower low here in this case. Then we have a divergence, we completely reverse. We also have something like a head and shoulders in this area, and another great example. So divergences are very, very great. They will happen pretty much all the time if you know how to look for them. Again, I really not recommend that you start using the RSI divergence on its own. Look for other things that you can build around it. If you want to know how I use the RSI, there is a link in the video below to our trading courses. I trade different setups, and one uses a different version of the RSI divergence with different signals around it, so that we can filter out the bad trades that would not work out and focus more on the good trades. And you will learn everything how to build it together, how to create a good trading strategy, and how to use the RSI divergence and many other tools. And I hope you enjoyed this video. If you find it helpful, leave a comment below. Again, let me know if you are interested in maybe exploring different areas of not only trading, but about trader development, where I talk about mental aspects, not only about trading, but in life in general. If you want to learn more about that, leave a comment below, let me know. And I look forward to hearing from you, and then see you in the next video.